welcome to Griffonomics.
Glad to be here for this one because it's quite the story.
It really is. I mean, think about it. How does a software giant intentionally blow up its foundational partnership, watch 4 of its absolute biggest clients walk out the door?
Right, and then suffer a 45% stock plummet on top of it.
Exactly. And yet somehow they still get called one of the safest bets in the market. That is the contradiction we are looking at today.
Yeah, I mean, if you just read the headlines, it sounds like a company in complete freefall. But when you peel back the layers, you are actually looking at one of the most calculated, high-stakes corporate gambles of the decade.
Which is exactly our mission for this deep dive. We are sorting through a massive stack of recent fiscal year 2026 earnings transcripts, investor day presentations, and some really detailed strategic analyses for a company called Veeva Systems.
And the goal here is to give you, the listener, a granular strategic report, an actionable investment roadmap.
Right. We are exploring Veeva's fundamental transformation. They're moving from being a specialized customer relationship manager, or CRM, into this comprehensive life sciences industry cloud.
It's a massive pivot.
It is. We're going to unpack their high-stakes Vault CRM migration, an untapped $1 billion clinical trial opportunity, and their fascinating new usage-based monetization of agentic AI.
To really understand how Veeva plans to reach the ambitious targets they've set, like hitting that $6 billion revenue run rate by 2030, we first have to understand the incredibly sticky foundation they've built today.
Yeah, they aren't just selling a simple point solution anymore, are they?
Not at all. They have essentially evolved into the digital backbone of the entire life sciences industry.
They call it the industry cloud.
Yeah.
And it's basically an interconnected ecosystem built on 4 main pillars. You've got the development cloud, which handles all the deep R&D stuff.
Right.
Then the quality cloud, which governs the actual manufacturing of the drugs, the commercial cloud for marketing and sales, and finally, the data cloud, which includes products like Compass and Open Data.
And the financial infrastructure underlying all of this is just a machine. 84% of their revenue is highly recurring, subscription-based income.
Wow, 84%.
Yeah, and interestingly, the mix of where that money actually comes from is shifting. Right now, it currently sits at 55% R&D and quality, versus 45% commercial.
Okay, let's unpack this. Because the way these 4 pillars interact is the real magic trick here. Think about the Apple ecosystem.
Oh, the sweet effect.
Exactly. Just like how buying an iPhone makes you want an Apple Watch, and then suddenly you're buying a Mac because, they all seamlessly talk to each other. Veeva has created that exact same sweet effect, but for highly regulated industries.
Spot on.
If a pharma company buys Veeva's clinical data management system, they naturally want the quality and safety modules because they natively speak to each other on the same underlying Vault platform.
It just makes logistical sense.
Right, but I get the convenience factor. Convenience doesn't usually create an impenetrable moat, though. I mean, why can't a competitor just come in and build a slightly cheaper ecosystem?
If we connect this to the bigger picture, you have to look at what these systems actually do on a daily basis. Veeva is providing mission-critical systems of record.
Systems of record.
Yeah. We are talking about the core infrastructure for global regulatory compliance. When a pharmaceutical company submits a new drug to the FDA, they have to prove that every single step of the clinical trial and the manufacturing process was flawlessly executed and documented.
Right, there's zero room for error.
Exactly. Veeva's software is actually validated by those regulatory authorities to ensure that compliance.
So it's not just the drug that has to pass the regulatory test. The software itself has to be validated.
Precisely. And because of that immense compliance burden, companies simply cannot rip these systems out or, turn them off during a macroeconomic downturn.
You can't just cancel your subscription to save budget.
No, you really can. It's not like a workplace chat app that you can swap out over a weekend to save a few bucks. It is the fundamental plumbing required to legally operate a life sciences company.
Right.
So the switching costs are astronomically high.
But see, that impenetrable moat makes their next move look completely insane to me. If their current ecosystem is so incredibly sticky and their customers essentially cannot leave, why are they intentionally shaking the table?
The CRM migration.
Yeah. Right now, Veeva is executing this bold multi-year move to migrate their core top 20 pharma customer base entirely away from their legacy Salesforce-based CRM and onto Veeva's completely proprietary Vault architecture.
It is a massive undertaking.
Over 140 customers are already live on this new Vault CRM, including global commitments from absolute giants like Roche and Novo Nordisk.
And management is explicitly calling this their Act 3. It's a horizontal expansion. Yeah, meaning beyond just moving their existing life sciences customers, they are initiating a push into horizontal enterprise markets completely outside of the pharmaceutical industry. And they're starting by building a non-life sciences CRM from the ground up.
I have to push back on this strategy, though. Let's look at the history. Back in 2015, CRM represented roughly 75% of Veeva's total revenue.
It was their bread and butter.
Exactly. The Salesforce partnership is what built this company. So if you have the dominant market share in pharmaceutical sales software, and it runs perfectly fine on Salesforce, why force a complex, messy migration on your biggest clients? You're practically inviting them to shop around.
I hear you, but relying on another company's infrastructure for your core product is just a massive long-term vulnerability.
Even if it's Salesforce.
Especially if it's Salesforce. By moving off that platform, Veeva gains total autonomy. They capture the profit margin that they previously had to, share with Salesforce. And more importantly, they control their own product roadmap.
Okay, so it's a margin and control play.
Partially. But the real functional reason, the true why behind this is data unification.
What do you mean by data unification? I thought the whole point of the Vault platform was that they were already unified.
Well, not completely. Think about it. If your sales and marketing data lives over on a Salesforce architecture, but your clinical and manufacturing data lives on Veeva's proprietary Vault architecture, those two sides of the house don't speak the same language perfectly.
Ah, so there's a disconnect.
Right. There's friction. By owning the architecture entirely, Veeva can unify the sales, marketing, and medical databases into a single, seamless system. Management views this as taking on a short-term transition risk to achieve total, long-term platform dominance.
You would think, though, a self-imposed migration crisis of this scale would absolutely wreck the balance sheet, or at least show some serious strain. But the exact opposite is true.
The numbers are pretty staggering.
They really are. The fiscal year 2026 results are in. And Veeva just absolutely crushed their long-standing $3 billion milestone. They reported $3.195 billion in total revenue.
Which is up 16% year over year.
Right. But the profitability is what really jumps off the page to me. $1.434 billion in non-GAAP operating income.
Yeah, that's an operating margin hovering right around 45%. In enterprise software, that is elite.
Seriously.
The balance sheet is practically a fortress right now. Because of those cash flows, they generated over $1.4 billion in operating cash flow this past year alone. Veeva is sitting on a $6.6 billion cash pile.
And absolutely zero debt.
Zero debt. And they are finally putting that cash to work. In January 2026, the board authorized their first ever share repurchase program for up to $2 billion.
Which is huge for them.
Huge. And they didn't waste time. They aggressively bought back $180 million in just the first month.
There was also a really major shift in how Veeva communicates its financial trajectory to Wall Street, though. They announced they're discontinuing their traditional quarterly billings guidance.
Yeah, that caught some people off guard.
Instead, they are moving to annual normalized billings. They're guiding for roughly $3.78 billion for fiscal year 27. I don't know, it feels like a strange time to pull back on transparency, right in the middle of this massive CRM transition.
It might look like pulling back, but it is actually a very intentional signal to the market. The $2 billion buyback and the shift to annual guidance, they work together.
How so?
Well, during a major software migration, quarterly billings get incredibly noisy. You have renewal timing shifts, early adoption discounts, temporary billing pauses while systems transfer. It's chaotic.
So the numbers bounce all over the place.
Exactly. By shifting to annual normalized billings, Veeva is telling investors to stop hyperventilating over the noisy quarter-to-quarter metrics and just look at the underlying annual growth engine.
Ignore the remodeling dust, basically.
That's a great way to put it. They are essentially saying, we have the cash to support our own stock, so ignore the remodeling dust and look at the foundation.
Okay, so how are they deploying that $6.6 billion cash fortress to actually accelerate the growth engine, beyond just buying back stock?
They're completely reimagining how artificial intelligence functions in highly regulated industries.
Yes, Veeva AI. We are seeing the rollout of this, where they embed industry-specific agentic AI directly into the Vault platform.
And this is a really critical distinction from the AI hype we usually see on the news. They aren't selling, a generic chatbot bolted onto the side of a word process.
Right, it's not just generating emails.
No, these are highly specialized AI agents designed to automate notoriously slow bottlenecks, like the MLR review.
The medical, legal, and regulatory review.
Yes. In pharma, every single piece of promotional material, whether it's a brochure, a website, a TV commercial, has to be meticulously reviewed by doctors, lawyers, and compliance officers to ensure it doesn't make false claims.
And that takes forever.
It takes forever, it's incredibly expensive, and human error can lead to catastrophic regulatory fines.
So where does the AI come in?
Veeva's AI agents act as a first pass. They check the new content against a vast library of already approved claims and FDA regulations, which drastically lowers the time required to get compliant content out the door.
Here's where it gets really interesting. It's how they are actually charging for this AI. They are shifting away from traditional seat-based licenses for these tools.
Yeah, the token model.
Right. They are rolling out a usage-based token pricing model. It is like paying a digital employee by the specific task they successfully complete. But wait, let me play devil's advocate here.
Go for it.
If I'm a biotech company, I am used to paying, say, $1,000 for a software seat, whether my employee logs in or not. That guarantees the software company gets paid. With token pricing, it sounds like Veeva's taking on all the risk. If the AI doesn't work, Veeva gets nothing. How does that make sense for them?
It makes sense because it perfectly aligns Veeva's revenue with the exact return on investment the customer is experiencing, and that removes almost all the friction from the initial sale.
Okay, that makes sense. Lower barrier to entry.
Exactly. If you try to sell a skeptical compliance officer a $1 million AI package up front, they will fight you. But if you say, look, only pay us a token when the AI actually completes a document review, they are more than happy to test it out.
And once they see it works?
Boom. If the agent genuinely saves that company hundreds of hours of legal fees, Veeva captures a direct, proportional slice of that value. And because the AI is highly effective, the volume of tasks it completes will eventually far exceed what a flat seat license would have generated anyway.
That's brilliant. So AI is clearly driving organic growth inside the Vault ecosystem. But they are also expanding their external ecosystem too. Backed by that massive cash pile, they recently made a $100 million acquisition of a company called Ostro.
Which is a very strategic buy.
Yeah, this integrates AI-powered patient-doctor engagement directly into the commercial cloud. So imagine a doctor visits a pharma brand's website.
Oh.
Ostro's tech allows for compliant, real-time chat between the brand and the provider, and all that interaction data feeds straight back into Veeva's CRM.
It closes the loop.
Exactly. Furthermore, the sources highlight a 10-year legal settlement with IQVIA, which ends a very long, very bitter dispute, and finally enables seamless data interoperability for their joint customers.
That IQVIA settlement is huge for the end users. But, beyond acquisitions and legal settlements, I think the most fascinating revenue expansion is how they are altering the way they actually sell the software.
You're talking about the CRO channel.
Yes, they are opening up the CRO channel. CROs, or contract research organizations, are basically the outsourced teams that run clinical trials on behalf of smaller biotech companies.
Right, because if you were a biotech startup with, 10 employees and a promising new cancer molecule, you can't afford a multi-million-dollar IT infrastructure to run a global trial.
You'd go bankrupt before you even started.
Exactly. So you hire a CRO to do all the heavy lifting.
Historically, Veeva sold its software directly to the large biopharma companies, the big guys. But now, they are allowing CROs to white-label Veeva's clinical tech for these smaller, study-by-study biotech projects.
So the CROs basically rent out Veeva's infrastructure to the startups.
Precisely. And this unlocks a brand new $1 billion business opportunity. Veeva is essentially letting the CROs act as their external sales force, reaching hundreds of smaller biotechs they could never efficiently sell to on their own.
We actually see a real-world example of this in the Investor Day sources. Dr. Evan Bailey from Applied Therapeutics, he showed how his lean biotech company saved millions of dollars in CRO maintenance fees simply because they standardized on Veeva's unified systems.
The ROI is undeniable.
Because the clinical trial data natively spoke to the safety systems without needing custom, expensive integrations, his team shaved weeks off the time required to compile integrated safety summaries for new drug applications.
And time is money.
In the pharma world, where a drug's patent life is ticking away every single day, saving weeks on a launch is worth an absolute fortune.
It really is the ultimate proof point for the suite effect we talked about earlier. Once a company experiences that level of speed and cost reduction, they are never going back to fragmented, disconnected legacy software. The technology clearly works.
But we have to look at the full picture here. We have to be objective. If the financials are a fortress, the AI strategy is brilliantly aligned with customer ROI, and the clinical products are saving companies millions. Why has Veeva's stock experienced a 45% sell-off from its October 2025 peak?
Well, the market hates uncertainty.
That's for sure.
And right now, Veeva is serving up a heavy dose of it. The primary driver of that sell-off is the vulnerability surrounding that Vault CRM migration we discussed.
Let's lay out the bear case clearly for the listener. During this very delicate window where they are forcing customers to migrate off Salesforce and onto the new Vault CRM, Veeva actually lost 4 of the top 10 pharma companies.
Yeah, that's a tough pill to swallow.
They defected back to Salesforce. And Salesforce is aggressively building its own competing life sciences CRM to capture those frustrated customers. On top of that, there's a literal ticking clock on this whole operation.
The wind-down period.
Yes, the underlying Salesforce agreement that powers Veeva's legacy CRM is in a wind-down period that completely expires in December 2029.
You combine that ticking clock with a significant concentration risk, too. Veeva's top 10 customers represent 28% of their total revenue.
Almost a third.
Right. And the life sciences industry is famous for constant mergers and acquisitions. When 2 massive pharma companies merge, they consolidate their IT budgets, which usually means negotiating lower per-unit pricing or reducing overall seat counts for software vendors like Veeva.
So losing 4 of the top 10 pharma giants to a deep-pocketed rival like Salesforce, right as you're trying to pull off this high-wire migration, I mean, that sounds incredibly damaging.
This raises an important question. Does the long-term structural gain outweigh the short-term churn?
That's the billion-dollar question.
It is. Losing those 4 mega clients is undeniably a heavy blow, and it is exactly what spooked the market. But we have to contextualize it. Veeva still expects to secure roughly 14 of the top 20 biopharma companies on Vault CRM.
Still a strong majority.
Exactly. The strategic math management is doing suggests that owning their own architecture, which dramatically expands their profit margins and allows them to sell those unified data products, will ultimately generate far more financial value than the revenue lost from those 4 churning customers.
So, weighing all of these short-term migration risks against the technological moats they are building, what is the ultimate verdict as you look toward the end of the decade? The strategic outlook from the analyst sources rates Veeva as a re-rating compounder.
Let's break that term down for a second. A compounder is a business that consistently grows its earnings year after year. A re-rating happens when Wall Street suddenly decides they are willing to pay a higher multiple for those earnings. Analysts believe Veeva will not only keep growing its cash flow, but that the market will eventually value that cash flow at a higher premium once the migration dust settles.
The sources also note that despite the recent sell-off, or perhaps because of it, the stock is currently trading at a 10-year low on an EV to FCF basis.
Enterprise value to free cash flow.
Exactly. Meaning the total price tag to buy the whole company, compared to the free cash flow it generates, is cheaper than it has been in a decade. The pessimism seems fully priced in.
The valuation is attractive because the path to their $6 billion revenue goal by 2030 is actually much clearer than the CRM headlines suggest.
Really? Even with the Salesforce threat?
Yeah, because the CRM migration drama grabs all the Wall Street attention, but the clinical solutions are actually the disproportionate growth driver for this company going forward.
That's true. CRM was 75% of their business a decade ago, but it's projected to be just 10% of their revenue by 2030.
The real growth engine is in the R&D and clinical side. And a massive proof point for this just occurred in the 4th quarter. A top 20 pharma company agreed to standardize entirely on Veeva's RTSM product.
Let's translate RTSM for a second. Randomization and trial supply management.
A bit of a mouthful.
Yeah. Basically, in a clinical trial, you need to make sure the right patient gets the real experimental drug and another gets the placebo completely blind at the exact right facility at the exact right temperature. It's a logistical nightmare.
It really is. And historically, biotechs bought RTSM software in a highly fragmented way, purchasing it study by study. Capturing a master enterprise standardization deal at the top 20 level that proves Veeva's clinical dominance is accelerating. They're becoming the default operating system for the hardest parts of science.
So what does this all mean for you? It means Veeva is a rare, complex mix. You are looking at an enterprise software provider with elite 45% operating margins, 0 debt, and incredibly deep economic moats backed by federal compliance standards. Yes, they are in the middle of a messy, high-stakes CRM migration that has cost them market share. But they are using that transition to build a unified data architecture, monetize AI through a brilliant usage-based model, and expand their addressable market by $1 billion through the CRO channel.
And if we step back and look beyond the 2030 roadmap, there is a much larger narrative unfolding here. Veeva is essentially operating a nimble internal startup to build out its Act 3 horizontal expansion.
The non-life science push.
Exactly. If Veeva successfully executes this and proves that its proprietary Vault platform can handle complex, non-life sciences enterprise data just as well as it handles clinical trials, could this specialized healthcare giant eventually break out of its vertical?
Oh, wow.
Could Veeva eventually become a horizontal enterprise software threat to the likes of Salesforce and Oracle across all global industries?
That is a fascinating thought to leave on. They aren't just pouring a new foundation for their own house, they are getting ready to build an entirely new neighborhood next door, risk-defined, portfolio protected.